Welcome to my own FP. In this video, we're going to start looking at how we update values from 2025 December, and we have a scenario that we like, MTI 2024, and our typical procedure is we're going to copy that scenario. We're going to update the accounts. There's a quick entry that you can do to quickly add all the different values for your investment accounts. And then we're also going to change some other accounts like our employment, because we got a slightly different raise than what it actually said. So we're going to manipulate that. We're going to run the scenario and do some comparisons. So let's take a little look at what Mary and Harry, what their new asset values are in this next slide. And you can see it's hard to see from there how much they've done, but they've done pretty well compared to 2024. So it might end up being quite a significant change from our MTI 2024 value. So let's take a quick look and see what we don't have it just as a copy. Then we're going to go to accounts. We're going to this little arrow here as a quick update on our accounts. So we're going to do, this is 2025. The month doesn't matter because it's last year. If it was current year, you can enter the month that you're trying to enter values in. So 2025. And we have, for Mary, we have $26,000. We're going to enter the same cost basis just for simplicity. Our non-registered has gone to... double check what it is. $115,000. Our RSP has gone to $480. Our TFSA has gone to $169. We're going to leave our liabilities and our property because we're just going to let that continue on from our previous scenario. It doesn't really, unless your property changes a significant amount, it won't really matter. So for Harry's, we're cash. We're at $24,000. His non-registered $123. Their RSPs $495 and $179. Okay. So we've now entered all of our new data for our investment accounts. We're going to modify our employment account. For Mary, 2025 is going to be $118,000, and we're going to update 61. We're going to do that in June. We're going to remove the previous one, so now this will just be for the 1 year. This will just be our value for 2024. This will be our value 2025. In 2026, it will go with inflation. If you wanted to add a slightly different inflation factor, you can say what your inflation factor is for this account. Maybe she's getting raises at 10% a year or whatever it is. And you can do that if you like. So, Harry, 2025. That's not going to continue. We're going to leave that at none. And his was $117,000. He's still going to retire in June. Didn't enter the 61. And so, okay. So he was 108. Now he's 117. Good job. Mary was 112, 118. So now we have their new employment values, and we've done their new investment updates. So now if we just run the scenario, we're going to instead of 2025, our CPP is at 70 still. The one thing that we want to do here is we wanted to do the computation not at 58. We want to do it at 59, which is 2026. Because we have 2025 values. If we left this at 2025, then the investment values that we just entered would not be used. We would use the 2024 values and start computing them in 2025. So once you update a year, you want to be able to move this to the next year so that we don't end up with not using the values that we want. Okay, so I run this. And we have our various scenarios. So in this case, you can see if you looked at the previous videos before, our RSP now is actually for MTI 2024. We ran our RSP out at age 80. Now we're actually at age 86. We're still using the rule withdrawal not to do $60,000. In the previous video, we did 60, then we tried a 55. At 55, it also went to age 86, but in the default MTI case, it was at 80. So that's what we're going to do. Other things that are still the same, our liabilities got paid off, our car is still the same, our expenses are the same, everything else is the same except for our new investment values, as well as our employment is now changed. So let's take a look at comparing the scenarios. So we're going to compare MTI 2024 and MTI 2025. We're going to quickly just look at the gross income. Where does it all come from? You can see on here, and let's just do joint 2025, 2024. I'll explain that in a minute. The RSP continues out to 2054, whereas in the MTI 2024 case, it got dropped off at 2047. So we've made a lot of money in 2025 on our investments. Maybe it won't be so good in 2026. But for right now, this is what the plan would look like. If you didn't run it last year, you'd like, oh, that's good. The fact that we ran it last year and now we've made a lot of money, and maybe you need to adjust it going forward or whatever. But this looks like even a better plan than we had before. The good thing about this plan in MTI 2025 is we're not taking anything out of our TFSA really until age 95. We still have some non-registered investments all the way out till 95. So that's a very useful plan. So if we get rid of this and let's look at our tax rates. So they've remained the same all the way out, 12% up until age 86 in the new plan. Last year they ran out at age 80. So, and then we do the same sort of thing. We'd just a little bit non-registered, and CPP and OAS are getting taxed in this environment here. If it was just CPP and OAS, which is what it was here, we'd be really just getting 5% tax rate. Okay, so this looks like a better plan, like paying, even though you're paying a little bit more tax going forward, that means because we have more assets. So that's not a bad thing. So let's look at our summary charts, which is always the interesting comparison charts. Let's look at our MTI, our residuals. So then let's look at joint. And then we have to click that on again and on again. So if you do joint, our residual before our state was about $9 million. We are now at $10.5 million. So based on that 1 year, based on the fact that this 2025 value is compared to our estimate was it was going to be 2.9 million. And now it's actually 3.046. So the difference there, $120,000 in our new investments. So therefore, that ends up at 95 being $1.5 million, or sort of, I forget what the number was. But if we do that in constant dollars, this is still $120,000. This ends up being 3,661, 234 or 42. So that's about $600,000 in constant dollars. So that's rather significant. We went from $120,000 to $600,000 in constant dollars. And if we look at the difference chart down below, and we expand that a little bit, just full screen, then we end up, everything is above the zero line. So the 2025 case now is definitely always, in all cases, better than 2024. We have more in our RSP, we have more in our TFSA, we have more in our residual. There's no negatives here. So that clearly, what we did in 2025, we got some money, additional investment income, additional, maybe we got money from somewhere else to put into our TFSA, maybe we got some, whatever it is, it's changed the plan slightly, to the tune of $120,000 in 2025. So this is what it is. That's really the difference here in 25. These are actuals. And at the end of the day, that's going to be $600,000. And that $600,000 is going to be almost entirely in our TFSA. $598,000, $90,000 difference. And that's going to be a little bit in our non-registered account. Okay. So if we click on the different, that's our estate residual, our RSP, we keep more money in our RSP for longer. It still ends up at zero in 2054, which is our age 86. Right? So we look at that and go, that's age 80, or 86 is when we had some money in it. 87 is where it went to zero. Our TFSA looks great. We put more money. We didn't put more money during it in. We had a little bit more investment income here, $35,000 than we thought we were going to end up. We still keep putting money in every year, and because we had this, the growth, there's going to be growth more. So there's really no other. Now we will start getting new additions to our TFSA at this point. So the difference between the two different ones here is we're getting growth and we're getting TFSA contributions. And that's why this line is a different line than here. This is just growth. This is growth plus contributions. So this is why your TFSA starts growing a lot more still. So that 2025 is great. This is why you need to run your plan, not necessarily every year, but every few years. But if you put all your data in year after year after year, then you can sort of see how your plan changes. Maybe you then want to take out more money in your, why do I want to end up with an estate of, in constant dollars, whatever that was, $4.3 million. Maybe you don't want that much estate. Maybe you do. So if you don't want that, then you could take out more money. Instead of $60,000 every year, take out more, put more in your expenses, add a trip expense, add something else, enjoy, enjoy. But, don't do that necessarily because of one banner year. Next year, you could end up in 2026 when we put those values in, maybe it's a 2%, so it's going to be a lot less, and it'll actually go down relative to 2025. Or maybe it'll even be negative, and then it'll, could end up erasing all of the 2025 gains. You don't really know. So you want to sort of look at this year after year and multiple years, and then, every few years, 4, 3, 4, 5 years, maybe adjust your plan. I have that much extra money. I'm going to do, gift that to something. So put that as expense that you're going to gift that money, or charitable donation, or whatever it might be. But keep adjusting your plan. Take more money out. Take trips. Don't take trips if it's gone down dramatically, sort of thing. So it's useful to keep putting the data in and understanding how my plan has changed. And what you're really trying to look at is, am I ahead or behind? In the previous plan, our RSP ran out at 80. Now it runs out at 86, which is still a good number. We're not paying that much tax on it, so let's not worry too much about that. And that ends up as still you end up with $600,000 in today's dollars in your RSP, or your TFSA at the end of the day. So take a look and update your new values and see where it goes. This model is better. The more data you put into it, the more you can see and compare against previous data. So that's what I would recommend. Don't delete your old data and then just put in new ones. Add them to the account for new data, and just keep running the report from the original 2024 data going forward. So I think that's all we have for this, updating the account values. So enjoy that and update your values and see how that works for your scenario, and or maybe change your scenario to maybe reflect the new values that are being updated. All right, let's look at one more thing in our 2025 update case. So let's look at what our initial one was, which was 2024 data. CPP at 65, and the default RRSP plan. And then we're going to compare that against our new plan. And we're just going to go right to the bottom again and look at our comparison chart. My favorite one is always going to be this difference chart. So this is very interesting. We're also going to look at this in joint. Let's look at it in real dollars. So in real dollars, we would end up with $1.6 million more in our TFSA. And also at our net worth, and I'm not sure where our MTI line is going to end up. Our MTI is our net worth. So we end up with a slightly lower RSP. We have to pay a little more tax. So basically, we end up with about $1.6 million in our $2062 in our estate between these two. So, and that is again CPP at 60. This is now this line. The positive thing is changing or using MTI as a rule. CPP at 70. And 2025 values. So a lot of that is just going to be, well, we made a lot more money in 2025. Therefore, it's going to be significantly higher. So, but that is the new plan based on compared to our just the default setup that we had originally. So that's rather significant. If we look at that in 2025 dollars, it's still going to be around $700,000. So let's just look at the residual. So $670,000 just by more money, CPP at 70, MTI rule. That's what you're going to end up with. Now, the RSP does go a little bit negative in the MTI 2025 case relative to the original plan, because the original plan had our RSP going all the way out to 95, sort of thing. So you could still do the default plan with the new rules, and 2025 you can quickly do that. So understanding what rules work well, and all of a sudden now I have a change in my values, therefore I should change things. Again, I would caution doing that on a 1 year basis between 2024 and 2025, because it doesn't always, markets don't go up by 20+% every year. It's likely going to go negative for something in the next couple of years. So be careful with that. But it's fun to look at it and try to understand, especially when everything is above the zero line and all the new plans are better than the old plans, and I'm ahead of the estimate. That's a good thing. It's never a bad thing. You can always take some money off the table and put it in cash or put it in some conservative investment, so that that plan ends up being more likely to happen than otherwise. So and you can do that by creating a new cash accounts or a different RSP account or whatever, with just having different rate of return in each account. So just wanted to sort of show that the two items between 2025 update, CPP at 70 and all that versus the initial one is quite significant. You can look at each of these different ones on its own and compare each of them, sort of thing. So if I wanted to do, look at that compared to the CPP at 70. So the 25 update and these ones both have them at 70 now. I clicked them the wrong way, I guess. If I click them that way, then above the line is what the one we want. Otherwise, the subtraction is the other way around. So here in 2025, we were at $670. So Here we're going to be about $250,000. So, definitely the CPP at 70. These both have CPP at 70. So that really, if you think about it, that at this tail end here, that was a huge win compared to the other one. So compared to the initial, so that would effectively be that 400,000 extra for. Sorry, that was joints. Let's let's just double check that. So yeah, so this is now the new updates versus the and new updates and MTI rule versus the default rule and 2024 values. So you can take a look at that. So now we were 670 when we had the default at the CPP at 65. So that definitely CPP at 70 is a winner for both of these ones compared to that. And then we did this comparison as well before. Then we got to do it the other way around. We're going to change that so it has a 1 and a 2, so you know which one is going to be subtracted. Right now it's a little bit hard to understand. So if we look at this now and we look at joint and $20-$25, so a lot of that change now has to do with the 2025 value, right? So we're $600,000 versus $600,000. So really the thing to look at is that new value setup that we have is changing our scenario quite a bit. So CPP at 70 definitely did. The rule between taking MTI versus the default rules, I think that one ended up being plus or minus of tens of thousands of dollars, like $10,000 or $20,000. So that one doesn't really matter as much. And that is really, am I taking out of my RSP or a little bit out of my non-registered. So again, that depends on the account values in every client's scenario. It can be quite different for different people. So sometimes you absolutely need to have that MTI. Sometimes the default rules are good. So take all that and do what it is. Manipulate your own scenario with different rules to try to figure out what works best for you. Okay, there you go. Thanks very much. And that's just comparing a couple different scenarios as well at the same time. Take care. Bye. So thanks very much for watching. And I think in the next video, we're going to do a CPP sweep against the 2025 data and see, if we took CPP from 60 to 70, what that would actually impact our plan. So thanks for watching this one, and hopefully we'll see you in the next one. Take care. Bye.